It's just after 4 o'clock outside the New York Stock Exchange. I'm Olivia Bono-Voznenko, and I bring to you Stephen Guilfoyle from Stuart Frankel. Hello, Sarge. Thanks for meeting me after hours.
Oh, how I look forward to Thursday afternoons with you.
So do I. Well, last week's payroll numbers seem to disappoint as Fed fodder for a rate hike. Will tomorrow's retail sales be the saving grace?
Yeah, there's a whole lot more to it than that, though. I mean, the jobs numbers last week were somewhat disappointing. There was actually a net loss of full-time employment, which was really a hidden surprise, which I don't think too many people focused on. Retail sales are supposed to be pretty good. Even without the autos, it's still supposed to be pretty good. So we're expecting a rebound here for September, which we haven't seen decent numbers in this space since June. But more importantly, as far as the Fed is concerned, are these Chinese export numbers that we saw yesterday. All right, down 10% year over year, which just in August, they were down about 3-point-something% year over year. So this is a real negative that you saw really act out in the markets today. Around the world, most equity markets are down about a full percent. This makes it tough for the Fed to raise rates as they want to. They've already used China as an excuse earlier in the year for not raising rates. So if the engine behind world growth throughout this whole crisis era that we've been in, isn't there, and we've seen also weak export data from Taiwan and South Korea as well. So really, if there's a lack of demand in Europe and in the US, that really creates bigger problems. And I don't know how the Fed will tackle that going forward. That's why you saw financials, which have been pricing in a rate hike, very weak today. And that's why you saw utilities, which everyone's been taking profits in utilities now for about 3 weeks. All of a sudden, they got a boost today because everyone's not so sure about where they're going to go with the rates.
Yes, I'm glad that you brought up China. There seems to be a global scare about the economy. What further effects are we seeing?
Well, see, as I said, as the engine for growth that they've been. Now, China's been trying to fix themselves a soft landing for quite some time. They've been backing up on yield, on GDP now for a number of years, 8%, 7%, mid-sixes. At some point, it looks like they'll probably be trying to hang on to the low sixes, which is below their target. If China isn't there, if we have to rely on things like domestic demand, and the Europeans too, well, it's a tougher thing to fix. Well, I guess we're the demand, but if our demand isn't there, and then China isn't needing to build, to produce, then resources will suffer. So you'll have the Asian Rim in a bit of a pickle. You'll see some safe haven buying. That's what you saw in treasuries this morning. That's what you saw for the Japanese yen. It's not the end of the world because these are year-over-year numbers and not month-over-month numbers, and they are in dollar terms. But it certainly creates a situation that the Fed obviously will keep their eyes on. Janet Yellen is not going to go ahead and blunder into something if she is afraid that something bigger is out there.
Sarge, tomorrow we're going to be seeing a slew of bank earnings. The Wells Fargo CEO stepped down, and there seems to be quite some pessimism for this earnings season. What are we going to see tomorrow?
Well, not really for the financials. As I said, yields have been stronger for about a month now. The financials are expected to be the leading sector for this earnings season. We're looking for about a 16% improvement from where they've been. Now, they've been probably the only sector that hasn't, even though the stocks haven't done that well until the last few months, it's the one sector that hasn't really seen the quarter after quarter after quarter negatives as some of the other sectors have seen, that the S&P 500 in general has seen. So I think you need to see some good numbers here from these four main financials that will report in the morning and from the other financials that will report over the next week or so. If the financial sector misses, well, then we're in for some. We'll be in some deep water. Then we'll be in some trouble. But as long as we get some decent numbers tomorrow out of J.P. Morgan, who knows what Wells Fargo will report, but out of the other banks that are going to report, and out of the banks next week, we could be all right.
Now, if retail sales miss, if financials miss, what do we need for that rate hike?
Well, you still have industrial production on Monday. We can still get a good number there. A lot of the manufacturing data has been better in September than it's been in the past. Now, it's still pretty bad. The manufacturing sector here has been really in the hole. But outside of that, you'd have to push on to next month's data. I mean, they're not going to raise rates before the election, even though the election seems like a foregone conclusion at this point. They're not going to raise rates in November. So to raise rates, you need 2 months of good data, not just one. You can't you can't just say go ahead and do it. Although the way they're speaking, they're so hawkish. It's almost as if they haven't paid attention to GDP over the last year or so, but we know they have. Maybe they're afraid of a recession down the road, but maybe they're afraid of something. Maybe they're afraid of somebody that's telling them to raise rates. I don't know, but they do seem afraid.
Well, Stephen Guilfoyle, thank you so much for joining me after hours, and until next time.
Until next time.